Are you making the most of your dividends? Some investors swear by automatic reinvestment, while others prefer cold, hard cash. Which strategy builds more wealth, and which one could be costing you big? Stick around because at the end, we'll reveal which approach might be best for your financial future.
Moving forward to our fifth thing, we'd like to cover educational topics about investing. Today, we're going to be talking about automatic dividend reinvestment plans, DRIP, DRIP for short as an acronym. Gary, what I want to start with is we're going to talk about the pros and cons of these dividend reinvestment plans. But why don't you first tell us what is a dividend reinvestment plans? What should our listeners know when they hear DRIP?
All right. Well, first of all, that is one of the worst acronyms in finance. Whoever came up with that is horrible. But yeah, it's the dividend reinvestment plan.
Not I.
Yeah, we this one is not on us. We've come up with plenty of dumb titles, but this one is not ours. Let's start with the basics. Let's talk about what a dividend is. It is a return of capital from a company to shareholders. So, if a company were to make, I'm making this up, a dollar per share in a year, they might say, okay, we're going to take 20 cents of that and send it to shareholders as a dividend. Now, I'm making up those numbers, but that's how this can work. Now, do dividends matter? They absolutely do. And in fact, multiple companies that we own in the deep knowledge investing portfolio are very high dividend paying companies. We bought shares in multiple publicly traded limited partnerships that had, at the time we bought them, an 8% dividend yield. And this is at a time when the 10-year treasury was yielding maybe 3%. So that is enormous, right? Where supposedly risk-free US treasuries were yielding 3%, 4%. We were getting more than double that with capital appreciation. So we were crushing, our income on this was crushing what you get in US treasuries. And that's why this matters. So typically, if you buy stock in a company that pays a dividend, when that dividend is paid, they just put the cash in your brokerage account. And that's terrific, right? You have this current yield and your cash balance goes up. Here's what happens with a dividend reinvestment plan. Let's say, Rob, for example, you own stock in a company that pays a dividend and you enroll in the dividend reinvestment plan. And let's say the dividends on your particular investment are $1,000. So without the dividend reinvestment plan, they would add $1,000 in cash to your brokerage account. And then you could spend that or buy other stocks or do whatever you wanted with it. With a dividend reinvestment plan, on the day that that dividend is due, instead of paying you the $1,000, they buy you $1,000 worth of that company's stock. So basically you're saying, you know what? I appreciate the dividend, but instead of sending me the cash, right, put that, let that go into owning more shares. I just want to reinvest this, right? Don't send me the cash. I want to reinvest it and own more of the company that, actually, technically you own the same amount. You'd own more shares, right? But instead of them sending you the money, you own more shares. And that's the how to think about it and separate that.
Gary, what would you say benefits of these dividend reinvestment plans? If this is something in which you're invested in stock, dividends are being distributed, what would be the benefit for investors?
I think the biggest one is compounding returns, right? So, dividends can grow over time. And, one of the things that is really interesting when you look at companies that have paid dividends across decades, people who own those stocks over decades will often be in a situation where their annual dividend from that company is greater than the total amount that they invested in the company decades earlier. Well, now think about what would happen if they were reinvesting those dividends, right? You could get compound returns, and where the newly purchased shares begin to pay more dividends themselves. Remember, if you're buying shares in a company that's paying dividends, right, you would then get the next year, you would get the dividends on your original shares and the newly purchased shares. There are some other benefits as well. Sometimes DRIPs, I can't believe I'm using that acronym, they may offer shared discounts or reduced investment fees, and that would give the investor a small bump in returns. Does that matter? Not in any particular year, but again, if you're doing this across decades, these things do add up. Finally, DRIPs don't require any management, and they allow investors to continue to invest without the stress of deciding how to allocate newly arrived capital. It basically forces you to keep investing in the companies that you like, as opposed to having cash that you need to figure out what to do with. Now, for me, as somebody who's managed money professionally for decades, I like having cash in my account because I'm always looking for new opportunities. If you're working a full-time job and taking care of a family and a home, you may have other stuff going on. Like, I don't have other stuff going on. This is my focus all day, right? You may have other stuff going on and may not want to think about, okay, now what do I do with this?
Yeah, great point, Gary. And I know personally, yeah, that's kind of the boat I fall into as well, right? Is that ability to just reinvest for all the benefits you mentioned. Let's
Yeah, but
shift
the difference
gears
is I
though.
take your calls.
That is true. Well, hey, there's a premium subscription for everything, right? You just got to host a weekly show for an hour or two, and then Gary, you can pick up the phone and call Gary.
There you go. If you want to
Gary,
replace
drawbacks.
Rob, IR at
No, 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 no,
deepknowledgeinvesting.com.
no. Then he won't answer my calls, so then I'll be really in trouble. Then I'll have no value. Gary talked about the benefits. Now, flip side of that, right? You maybe highlighted a little bit, probably some control, flexibility, right? But what are maybe some of the drawbacks of drips or just things to be aware of?
So there are a couple of things. One is you may have a lack of liquidity and control when it comes to using these investment plans, right? Remember that if you buy stock in a company, you're buying stock in a company, you choose your entry point, you choose your exit point. Um, by reinvesting your dividends, you do not control when you're buying shares. It will be done for you on a particular day at the price that the stock is that day. Um, Also, it's important to note that dividend reinvestments are taxable by the IRS and they're treated as if they would be collected in cash. I'm just going to highlight we are not tax advisors. Deep Knowledge Investing is not a tax advisor. We are not giving tax advice. If you have questions on this, check with your tax professional regarding your personal circumstances. But the thing to point out is, depending on your circumstances, you could be in a situation where you reinvest that money and then you owe cash taxes on it. And, there's no guarantee that the stock that you reinvest in will go up over that time period. So you could have a situation where the money is reinvested, the stock goes down maybe temporarily, but you might have to sell some of it to pay a tax bill. So you need to plan for that. It's also worth noting that drips are specific to one company only. And so it makes sense if you want to invest more to a particular company, but you may want more diversification or to disperse those dividends across multiple investments. It's really a matter of how much liquidity and control and diversification you want. And drips, while great in many ways, will give you less of that diversity, less of that control, portfolio diversity I'm talking about, not personal. And then you just have less control over that. And so that's the downside to it. And that's the thing to keep in mind.
Gary, just to wrap up this educational topic, let's focus on the beginning investor for this last one. But what's kind of, for you, speaking to a beginning investor, what's really the key takeaway? What do they need to know about dividend reinvestment plans when considering their options?
So I like that you're delineating here. Like, I don't personally use dividend reinvestment plans because I'm always looking at allocating capital. Again, this is what I do all day, every day. For a beginning investor, it might be tempting to take cash dividends and not reinvest, but just a reminder, the best time to begin investing is at a younger age. The next best time is now. And so dividend reinvestment plans offer people, beginning investors, an easy, low-cost way to reinvest dividends for long-term growth. Compounding for a longer time can result in larger dividend payments down the road that, you may decide to collect those in cash when you reach an older age and you use that account to fund a retiree lifestyle. But, if you are a younger person, this is a great way to force yourself to not take dividends and spend them, but to keep investing. And this is something we were talking about earlier in this version of the 5 things. We were applauding more Americans for saving more and investing more and spending a little bit less, or rather increasing their spending at a slower rate. This is a great way to be doing that. That really, Rob, I really should have renamed this episode the, consumer responsibility episode. Or the investor responsibility episode. And it's great to see all of you guys doing a much better job. The last thought I have on this topic regarding the dividend reinvestment plan, and I do think it's a good thing for beginning investors, but if you wouldn't buy the stock at current prices, you might consider whether you want to own it at all, right? So if you use the dividend reinvestment plan and you're saying, wait a minute, I wouldn't pay today's price, then you own too much of it in your account and maybe you need to reallocate to something that's less expensive. So, a lot of times people like to look at their historical cost. Professional investors will tell you, do not do that. Your historical cost doesn't matter. You own your portfolio every day at the current price. So if you wouldn't buy it, you might want to sell it.
Yeah, I think that's great advice and a great way to wrap up this week's version of the 5 things, Gary. And hey, someone's got to be responsible at some point, right? We've been talking about all this irresponsibility over the past 3 years. So cheers to the consumers, to the retail investors. Great stuff that we're seeing. And again, if you have any questions, please leave a comment, head to the website, use the Ask Gary feature. We'll be glad to circle back on some of those questions that we receive.